Prediction markets are often seen as crystal balls for the future. You look at a contract trading at 50 cents, and it's tempting to say the event has a 50% chance of happening. But this interpretation misses a crucial point. Market prices are not pure probabilities. They're clearing prices, shaped by much more than just informed estimates of what might happen. They reflect liquidity, sentiment, narrative momentum, crowding, and the ticking clock to expiry. This distinction isn't just academic. It's the foundation for why mispricings, and thus trading edges, can exist in the first place. To move beyond surface-level interpretations, let's explore a more disciplined framework for trading in prediction markets, one that treats market prices not as isolated guesses, but as evolving paths through a sequence of states. This approach is built on three main layers: data, dynamics, and execution. First, the data. Not all market histories are created equal. To build a reliable model, you need robust historical price series. That means reconstructing price histories from order book data when possible, or using trade-level data as a backup. Contracts with prices too close to 0 or 1, or those near expiry, are excluded because they behave unpredictably. Thin data or short histories also get filtered out. The model is only as honest as the markets it's willing to ignore. With good data in hand, the next step is to shift focus from price levels to state transitions. Instead of asking where the price is, ask how it moves. The price range of each contract is broken into discrete states. Think of 10 buckets from very low to very high implied probability. The current price maps to a starting state, and historical data tells us how often prices transition from one state to another. This state space model captures more than just the final price. It preserves the path, distinguishing between a slow drift and a sudden jump, even if both end at the same point. But markets aren't always calm. Volatility plays a crucial role in how prices move between states. Here, volatility isn't used to predict direction, but to classify regime. A volatility factor compares current market turbulence to historical norms, adjusting how the model interprets jumps and oscillations. In quiet periods, the model expects continuity. When volatility spikes, it allows for bigger, less predictable moves and scales back risk. This conditioning is essential. Early versions of the model that ignored volatility lost sensitivity and produced misleading results. Once the transition structure and volatility conditioning are set, the framework uses Monte Carlo simulation to generate possible future price paths from the current state to expiry. The time horizon isn't fixed. It adapts based on how much time is left until the contract settles. The simulation produces a distribution of possible terminal states. But it's important to recognize that this output is not the objective probability of the event. It's a model-driven frequency, not a crystal ball. That's where calibration comes in. Raw simulation results can be biased, overconfident in some scenarios, underconfident in others. Calibration bridges the gap, using historical relationships between model output and real-world outcomes to adjust the probability estimates. Only after this step do we have a probability that can be meaningfully compared to the market-implied odds. The trading edge is defined as the difference between the calibrated model probability and the probability implied by the current market price. If the model's probability is higher, there's a potential edge on the yes side, if lower, on the no side. Tiny differences are ignored as noise. Larger gaps are grouped into stronger signal buckets. But knowing where the edge is doesn't mean you should go all in. Position sizing is handled with the Kelly criterion, but only fractionally. This means using a conservative approach that further reduces position sizes for slippage, liquidity constraints, and model uncertainty. The goal is not to maximize theoretical returns, but to survive the realities of live trading. So, what does this framework actually achieve? It doesn't predict the news or claim to know the true underlying probability of an event. Instead, it systematically identifies when the market's implied odds are out of sync with a disciplined, calibrated model of how prices tend to evolve. Its strength is in finding these dislocations, not in making sweeping claims about market irrationality. Of course, the framework has limits. It works best where there's enough liquidity, history, and structure for transition-based inference to be meaningful. It struggles in thin markets, near expiry, or when unpredictable shocks hit. But by focusing on disciplined inference, robust calibration, and conservative execution, it offers a practical roadmap for navigating the complex, reflexive world of prediction markets, trading not the news itself, but the transitions between states that prices move through.